All right, cool. Cool. So welcome to our community talk on shares versus tokens. I think that's what it is. Yeah. So I'm gonna not share my screen because last time this led to some weird issues. So I'm gonna try this time just do like this, and then maybe do another dry run, and try and see if I can get it done. So shares versus tokens. The idea really for this article came, a long time ago, because I always had this like question: what makes tokens valuable? Actually, what is it, and what's the difference to what makes shares valuable, right? And this ties into this whole like, are governance tokens valuable, or do they accrue value, and all that kind of stuff, right? It even ties into what makes I guess like Amazon shares valuable, right? If they don't pay dividend. And so I really wanted to dive into that and kind of create or write down my thoughts. And I guess this is only a first piece. There's definitely more that we can write about it. But essentially, the way I broke this down is that I looked at like a couple of different trends, right? If you compare shares versus tokens, and it's not only shares versus tokens, but it's also traditional businesses and crypto businesses. And like with the tokenomics design framework, that's like one of the first questions is like, what does your business do? We have this evaluation framework. It also talks about the same thing. It's like, what does your actual business do? Because many people who design their token, they forget that. They don't pay attention to the actual business side, and they have like a pie chart of their token distribution, but that's about it. And so I thought, like, in comparing these two, I'd go through 6 different topics, right? And so there's 6 different topics that I evaluated this all with, and I've got the article open if you want to open it up as well. I'm just gonna jump around in it, and I'm not going to make this too long of an intro, but at the very end of the article, that's my summary. So I'm just going to start with that, because I think that's kind of what I see as the key points, right? We've got supply, and like my point is that supply in traditional businesses, it can increase over time. And I posted this example of Amazon, right? They've increased their shares outstanding over the years. And in crypto, that of course happens as well. We all know that. The reason why, like, at least I personally, if I buy an individual stock, I don't actually look at if their shares outstanding is increasing over time. I don't care. Because there's not a lot of outliers, right? Whereas in crypto, you have definitely got the Klima DAOs and the Olympus DAOs with hyperinflationary tokens. People just like to try out stuff. And that's why I think this, this is something that if you compare shares versus tokens, or if you look into tokens specifically, supply is something you should have on your radar and look into and find out. And like, inflationary supply doesn't need to be bad, but it kind of just needs to match how the business grows, right? And yeah, guys, feel free to jump in at any time with comments or questions. Then the next thing would be utility. That's the point where I guess most people are familiar with in crypto, right? It's like, whatever, you can have a lockup, you can have some staking, you can use it for payments, all these different things that crypto tokens can do that shares often can't. And we know how to look into that. And that's really what the focus of crypto is. So I don't think this is really a super important one in comparing shares versus tokens, right? Because the crypto world is well aware of utility and mechanisms. So then the third bit is, I think I mentioned that already earlier, is fundamentals of crypto and traditional businesses. And that's something we kind of like, we don't really spend too much time on, or at least that's what I have seen, or that's what I feel, right? Many people come to us and they want tokens designed or want help creating their token. And it's like completely unclear what their actual business model is, how they're going to make money, and how they're kind of set this all up. And but they're already thinking about tokens. And so my advice always is like, try and figure that out first. And if you have that, then it's going to be a lot easier to do your token. So that's fundamentals. And then from that, I guess it's good to compare to stocks. And for stocks, or the way most people evaluate stocks, I just copied in or just took like a couple of metrics, I guess. And you're probably really familiar with those. Most of you guys are. There's just a lot of things around earnings, and if like earnings per share, price to earnings. And if you are a startup or a smaller market cap company that might not have profits or earnings, then you can look at revenue, like a price to sales ratio, which pretty much divides the market cap by revenue. And that gives you then a ratio, right? And I think that's something we can then use to look at how to evaluate tokens, right? So if you have a token, that's probably a good place to start. Like let's say you want to investigate one that you want to invest in. I think that's a good place to start. So if you then go ahead and take that and try and find out, you can go to a place like Token Terminal. I don't know if you guys know that, but it's a great site. You can. I'll post the link as well, in case you're not familiar. Just going to open up the dashboard. So in the chat, I'm just going to post that. Oh, faster than you, Mason. In case you wanted to post that. So then on the left side of Token Terminal, you can kind of, you can go through metrics and markets and stuff like that. And if you click on metrics, they actually have it right up there, the price to sales ratio. And so you can open up your price to sales or price to fees or whatever they call it, and it will show you for different protocols what that would be, right? And then you can, if you're lucky, you can compare one to the traditional businesses that I showed. So in the article, like I go into like smaller or mid-sized tech businesses. They range from like 4 to 6 price to sales ratio. And if we look at Looks Rare, they've got like 6.2. So it kind of like doesn't look too bad, right? If we don't know much about revenue. They're often not really open, or it's hard to find out, right? Because it's less regulated, the field. So I guess they don't have to publish these numbers, but it's just purely looking from the price to sales ratio. Looks Rare doesn't look that bad. And then I guess like in the article, I then go on and there's something that Kerman Coley, I think is his name, he pointed out in one of his articles, and he just overlaid that with token incentives. And you can do the same in Token Terminal, right? If you open up Looks Rare and you go to their, if you go to their specific revenue over time on a chart and you overlay that with the token incentives, you'll see that that's like almost like 100% correlated, right? So the time they're like, and token incentives is the incentives that they pay to users to do certain stuff on their platform, right? So the point or the point in time where the token incentives go down, that's also when the revenue goes down. So yeah, that's probably something to take note of, right? And bringing that back to the shares versus tokens topic is shares are a lot easier to evaluate, right? Because shares like won't be handed out as incentive to people, or at least not in the way that crypto does it, right? Sometimes employees get paid with shares, but in a lot of cases, it's not in that range in where it happens in crypto. So it's something, if you evaluate a token and you look at price to sales, then you should definitely look at what the token actually does and how many tokens they're spending to incentivize people to do stuff on their platform. And this like perfectly ties in with a lot of stuff that we've been always talking about, this cold start problem, that if you are trying to cold start your platform, a token can be really good, but you have to make sure that you stop the cold start, right? Like at some point you have to wean off the ecosystem off the token so that it really becomes sustainable. So I guess that's the second to last point. And the last point would be governance. And I just wanted to mention governance because I think governance is really this, it's an important bit that like pure governance tokens, I feel, are sometimes like people don't really give them a lot of love. But if that's the only mechanism is governance, then it kind of is like shares. I'm not sure what you guys think about that, but I think like it then can be a good proxy for the actual business. So if the business has cash flow and it's growing and all that, then the governance token could be a good proxy for that, just like shares would be for something like Amazon. Yeah. And that's kind of what the whole article is about, right? I want to leave everyone with these kind of thoughts on how an evaluation can go, right? If you look into a particular project. So, are there any questions on that? Any comments? How you have evaluated a token? I'd be really keen to kind of open it up and see if you have evaluated a token, how you do that, what metrics you look at. Yeah, if anybody's.
No, I just wanted to say thanks for the breakdown of the article and those useful references to the token terminal. It's I haven't seen that one before, so it's a great tool. I mean, just a comment from my side, kind of comparing shares to tokens. I would say that the VE model, right, of tokens like Curve or Balancer, I mean, that's getting very close to the shares itself. Apart from obviously the liquidity, I mean, once you have locked your once you're locked into the V token, I mean, you can't just sell it like you could with stocks, right? That's the major difference.
Yeah.
But other than that, I mean, you have the voting power. You receive the revenue stream from the business or the earnings from the business, like in the regular stocks. But obviously, the only downside of the V model is that you can't, well, sell your portfolio, right, of the given token, because it's locked and it's bound to your wallet. So, but for me, I mean, the two, for what I'm comparing and trying to kind of wrap my head around. I mean, mostly just like a quick intro. I mean, I'm part of the team building a project, and we are actually looking into the tokenomics quite extensively at the moment. And when I try to do some financial forecasting for the project we are building, and then refer to either the like traditional businesses or other existing DeFi projects, and since we're also considering VE model for our token, then it's actually quite useful and quite easy for us to draw comparisons using just price to earnings, right? Or price to, I think price to earnings. Obviously, for a new project, you have to do some assumptions and do some forecasting of what you are expecting, right? And based on, well, the market research and the competition research and market screening, right? Obviously, you don't have that data, but I'll say that, that you can actually draw quite good conclusions if you're operating with the VE model and compare it to existing businesses with a price to earnings, and the same goes for Curve or Balancer. I mean, you can easily get price to earning number, right, for these two projects too. So that kind of, it gives you perspective where crypto is with like price to earnings and where traditional businesses are. And I was actually quite amazed to see that Curve, I think they are about, I think price to earning is about 10 for CRV or VE CRV. And for Balancer, it's about, I believe it was about 3.5 to 4. So I would say Curve, if you compare to, to S&P blue chip stocks and whatnot, I mean, that would be considered cheap, price to earning ratio 10, if we only look at that metric. But it's not as cheap as I would have expected, comparing to, let's say, traditional tech business. So yeah, I was, but it was. I think it kind of, it's a nice tool that allows to kind of compare, right, and then to kind of set a little bit of perspective where crypto businesses are in the context of traditional business. So,
where did you get the price to earnings from? Like for Curve, or are you talking about price to sales?
No, price to earnings. So
okay, yeah.
Mm-hmm. So essentially, I mean, that's the data you can calculate yourself. You know what the price per token is, and
but the
I believe
earnings
you can.
Is really hard, right?
I believe there is on the, if you go to Curve dashboard, where the VE Curve dashboard, you can get, they actually tell you what is the price, sorry, what is the revenue per one VE CRV token.
Mm-hmm.
So
and then you can subtract that.
Yeah, exactly. I mean, divide one by another, right? And then you get the price to earnings. Of course, it's an approximation because you get your price to earnings per VECRV. Sorry, you get your revenue or you get your fees for VECRV, but you have the price of the CRV. So what you're missing in this price to earnings calculation is simply this, this time commitment that you also have to do, right? To get the, and how do you price that into the price to earnings calculations? That's really difficult, I would say. I mean, obviously, I mean, you are, if you want to like utilize your CRV 100% into VE CRV, I mean, then you are committed for 4 years, right?
Yeah, exactly. Yeah.
Which is then you could do some kind of opportunity cost analysis on that, right? I mean, how much opportunity I am giving up if I'm committing to a project for 4 years, right? Or token for 4 years.
Yeah.
I mean, you could
still kind of get rid of them via convex, but
you could. That's true. So again, it's probably far from being like very precise, this price to earning assumption. And this similar for Balancer. I just got those numbers, price to earnings, same way. I mean, you can get what is the revenue per one VE BAL, and then what the price of BAL is, and you can get this simple metric that way.
Mm-hmm. Yeah, and then you can get what's the price to earnings for Balancer or VE BAL?
It was about 4 or 3.5 to 4.
Okay, it's not too
pretty
bad.
Good. No, it's I mean, it's like if you turn it the other way around, VE BAL pays you what, 25% dividend, yearly dividend, right? If you
think
compare
like even more,
stocks.
like I think it's like 75 of revenue.
Yes, of revenue. But if you, I mean, no. What I meant is, when you buy your BAL token for let's say $100, then if you then lock it for VE BAL, you would get $25 of revenue per year.
Mm-hmm. Yeah.
So that's what price to earnings of 4 mean, right? Yeah.
Mm-hmm.
And in Curve, so if you had like 10 or $100 worth of Curve locked into VE Curve, then you would get $10 per year in dividend. I mean, for lack of better word, dividend probably is appropriate to use here.
It essentially is one, right?
It is.
Don't call it that way.
Exactly. Don't call it that way, but
regulatory.
It is what it. That's what it is actually.
Yeah.
I mean, it works in a similar way. I mean, there is literally no difference, I would say, between a dividend or a fee distribution.
No, yeah, I totally agree to that. Yeah.
So I mean, for me, from like a builder perspective and a person who is kind of talking to a lot of possible like investors, VCs, and whatnot, partners that are interested in the project. When I want to kind of put our project in a perspective, like the potential of the project or its token and whatnot, then I would use that P2E metric and use that Curve Balancer, obviously regular businesses, but then I'll try to position like a new project that is coming to the market into that perspective to kind of give, just to draw a certain picture. Obviously, a positive one for the project I'm representing, but that's sort of a simple way to kind of display, a potential of a project to someone that is maybe not so much into the tokenomics and all the financial details.
So you're kind of engineering or building your token, designing your token to achieve a certain PE ratio.
Not really, but no. So the objective is not to achieve a certain P to E ratio, but I'm rather turning it the other way around. So with the kind of certain expected TVL in a project, we could assume a certain revenue being generated by the project. Subtracting all the expenses, then we are left with a certain earnings that will be distributed with the token holders or VE token holders, and then knowing how much, let's say, how much would be distributed per one token. Obviously, there is another assumption. I mean, we have to assume how many people and for how long.
Is that
I think
just
we
me?
lost Firefly.
Okay, then we didn't lose me.
No, you're still here.
That's good.
Firefly, it sounded like your internet went down or something like that.
Or something, and we can't hear you anymore.
What about now? Can you hear me?
Much better. Yep.
Yeah, sorry, it was just my mobile rang, and since it's one headset connected to the mobile and the computer, then it switched to the mobile device. Anyway, so what I wanted to say, so basically what we're trying to do is, so knowing how much revenue we could expect per one VE token, then we can kind of do some projections of how the market could price the token in future. So let's assume the token generates $10 per token, per V token of revenue. And then you can compare, all right, well, Balancer has P/E of 4. So if you just multiply your earnings of the revenue by 4, then you could have the token price of 40. Obviously, it's a new project, so you'd probably be looking at a lower P/E than Balancer, so maybe 2, maybe 1, right? But you can then start kind of picturing a different scenarios, right? I mean, if you compare yourself to Balancer and P/E Balancer or P/E of Curve and whatnot, and so that kind of not directly, because otherwise if you just try to, because many projects when they are building, they're trying to say, yeah, the token has 10x, 100x potential or whatnot. I mean, but what is it based really on, right? I mean, everybody can guess. Yeah. I mean, we can all guess. Yeah, sure, this token is going to the moon, but yeah, based on what, right? And I'm trying to actually do it slightly like from the fundamental perspective, like, all right, so knowing those scenarios, this TVL and the TVL, well, we know we could expect this TVL comparing ourselves to the competition and positioning ourselves at a certain market segment. Then the fee structure we know, because this is what we are engineering ourselves. So that's pretty much a known fact. The only unknown there is, the popularity of our VE token. But you could say the less popular the VE token is, the more revenue is going to be given to those that engage with the VE token, right? Because there's less competition.
Yeah,
or less,
exactly. Yeah,
exactly. So, but eventually the market is going to realize this, and then if let's say, for again, lack of better word, the dividend is high compared to the price per token, then obviously the market is going to notice that, right? And it's going to draw more attention to the token and the VE version of it.
Yeah, exactly. If it pays a good yield, they'll bring in investors, right?
Indeed. So yeah, so that's sort of how I look at it, and this is how I try to present our kind of financial projections and the whole token design when I'm kind of presenting the project outside.
So, what do you think about in the traditional world, startups usually don't pay dividends, right? Or early companies, they don't give dividends, right? They focus on growth, they reinvest that. Now,
yes,
in the crypto sphere, I think a lot of people are striving towards paying a dividend because they think that brings them utility, right? Or that brings the token
indeed
some reason to hold it, right? So it's kind of weird.
There is
traditional world
creating a demand. Yeah,
it's a demand driver, right? Exactly. Yeah.
Mm-hmm. Because but the major difference, I mean, when you launch a startup in a traditional business, I mean, you launch your business with, let's say, 10 million stocks, and you don't inflate it every second or every day, right? You don't emit more, right? So that you could
do the same with crypto. I mean, you can like pump all the tokens on the market at TGE. That's what essentially an IPO does, right?
Yes, you could. You could. Yeah, of course. Then it really depends on how you engineer a token, right?
Yeah.
And then, but many projects. They introduce all those different utilities simply to drive the demand that offsets the emission, right? Kind of decompensate for the emission, you could say, right? So there is the emission, there is inflation of the token, even if you have a fixed supply of the token ultimately, but still there will be an inflation, right? So that what it means. Well, if you inflate your sort of the circulating supply from year to year, let's say by 50% even or 100%, I mean, essentially that means that your business needs to grow by that much.
Yeah, absolutely. Yeah.
So yeah, there is. That's it's really interesting. I mean, as I said, you can really launch a token in different ways. You can just just give it. Just launch it to the markets all in one go. But obviously, then the project loses a nice tool or leverage it has to kind of offer its own token as part of the whatever rewards, right? So to make the project more attractive. But if you do so, well, then you have to make sure that your business grows together with the emissions.
Yeah, exactly. You can't use I think mainly people use the token as a marketing tool nowadays in projects. And yeah, so you kind of have to balance that, right? So that your marketing tool doesn't outgrow your business.
Yeah, definitely, exactly, because then you just make it non-sustainable, right? I mean, it's just eventually it's going to get. I mean, it's coming back to you or to the project or to the holders of the token, right? Because that's ultimately what it is, I think. But if the token is really like an essential or core part of your of the entire kind of architecture that your project is offering or what is built on, I mean, then if your token is unsuccessful or drops in price, then the project is going to die as well. So.
Oh yeah. I mean,
so yeah, definitely.
Maybe you could just have governance, and then cash flow is the proxy, right? So everybody looks just at cash flow, and then they buy into it just same as they would with a normal stock. And yeah, that could be the number go up mechanism. But I think the whole VE thing comes in because of regulation purely, right? Otherwise, I don't think a lot of people would use it because you could just let token holders vote, right? I mean, the lockup, I see that it's like an additional incentive or additional alignment, at least, of incentives. But yeah, it also adds complexity.
It does. I mean, but you have, for instance, I think Sushi's governance, isn't it? That essentially, I believe you can participate in governance with your staked Sushi, right? Or if you have your Sushi locked in a liquidity pool, then you get double as many governance votes. I believe they have something like that.
Yeah.
I imagine
there's many out there. Like Uniswap doesn't have a VE token model.
Yeah.
It's just vote with your token, right?
It's but then they distribute, I believe, the revenue to the holders of those tokens, right?
SushiSwap? Yeah, I think so.
Yeah.
There's something. Yeah. Uniswap doesn't. Yeah, but that's true. Yeah.
Yeah. So even without a V model, I mean, you can still distribute. But then it's like literally like regular stocks, isn't it? I mean, there is no.
And then you get into security trouble, right? Yeah, you got to be careful with that.
Yeah.
I'm not a lawyer, but
no.
That's at least what I heard is dangerous territory.
It is. I mean, yeah. In general, I mean, building a project in this DeFi kind of space is, I mean, from start to the end is a dangerous kind of territory in terms of like compliance and regulation legislation. So, I mean, there is no clarity. There is no like. I'm now changing the topic slightly, but there is no like clarity and 100% set guidelines, and especially I mean it's blockchain can be accessed from any corner of the world. So I mean, how do you really comply with the regulations of 200 and something countries in the world? I mean,
yeah, I guess as long as you cover the US, that's a good start because that's sort of what everything builds upon. I think like the EU does it similarly, and then you've got the two biggest markets almost, right? covered.
Yes. Yeah. If you have covered these two, you're most likely well covered. That's correct.
Yeah.
That's correct.
Yeah, exactly.
So that was just some small insight. I don't know whether it was on topic. I hope it was. And
well, look, I think whatever it is, right? This community talk of it's just the shares versus tokens is just the intro, and then we can take it wherever we want to. I found that like really interesting that you managed to calculate the PE in that way that you did, right? So that's quite cool.
But I mean, what I said, I mean, I wouldn't really use it like as if I had to really do like a financial reporting on curve or balancer, I probably wouldn't use the numbers I had, but for the purpose of, let's say, putting the project we are building in a certain context and refer it to certain metrics, that was a very useful tool to have.
Yeah. Well, it's probably the closest that you can get to, right? Because most projects, and that's also because of regulation, they don't publish anything like that. No,
that's true.
Yeah,
that is true. But again, I mean, it's terminology in the end, but everybody knows what is going on behind the scenes anyway, right? So it's just just not use certain words, but what your token does is actually the same thing as actual shares do.
Yeah.
And like you find like the lockup to be favorable over something like what Sushi's doing with like simply staking for calculating like the P2E, or what's the reason behind the lockup? Like
so I would say yes, and especially if you combine it with, I think, the model that Balancer introduced, where you actually you don't lock the token, but you lock the the LP token, which is then, I mean, then you, as a project, then you make sure that you have liquidity locked for your token, which is fantastic, obviously, from the project perspective. Whether you could, you could achieve a similar objectives with the model Sushi has, I would think. But I think especially for a new project, I think it's attractive to know that certain circulating supply of the token is just locked, and it's not going to be just sold on the market. If the Bitcoin drops 1,000 tomorrow, right? For instance, I mean, it kind of offsets some of that risk.
it's like,
I imagine.
It's like working in batches, I guess you could say, so to speak.
Yeah, definitely. Because if you had a project, I don't know how big the market cap or TVL of Sushi is, but probably billions at the moment. They're in the position, or their project is I mean, it's a corporation essentially by now, right? So it's they have to some, they don't need it. They don't need the VE token, you could say, right? Because they are pretty much to some extent immune to that, or their whole financial or the business model they have is independent or immune from let's say Sushi's token performance.
Yeah,
maybe they know something about regulations that others don't, so they can still pay out tokens without having such a lockup.
It could also be. It could also be, right? I mean, it's I mean, I imagine. I mean, those large projects. I mean, they must be close to at some lobbying groups, right, or regulators, and then kind of be involved in the discussions, right, about like shaping the kind of the future of this DeFi space.
Yeah, and maybe it's even like the team being anonymous, right? Maybe that's also enough.
Yes, perhaps. I mean, I don't know how anonymous you can really be in this. I mean,
there's always a way to find out, I guess.
Exactly. And then if there are certain groups that have interest in finding out who is behind Sushi, I'm sure they can. It's
certainly.
I mean, I'm sure. Even like I don't know if Sushi is their team is KYC'd or any of that. But many projects, I mean, especially the new projects building now, I mean, if you like to retain your anonymity, then at least you need to kind of go through some sort of third-party KYC process, right? And so your identity is already sitting with some third party that perhaps, if pressured, they would release that data, right, information.
Yeah, they could certainly, yeah.
So, but I haven't really studied, how the team of Sushi is set up in detail. So I don't really know any more of that. So
yeah, we haven't done a piece on Sushi, I think, yet. Maybe
it could be an interesting one.
Wants to look into that and compare it to VE token models and how it compares to, maybe Uniswap as well. That'd be an interesting one.
But Uniswap, do they use the VE model? They don't, do they?
No, Uniswap just they're just a pure governance token.
Okay, yeah. So they don't share any revenue with the token holders.
No, they don't. Yeah, I think like the way, and I think we talked about that, or we at least have a piece on Uniswap. I think the reason why they trade how they trade is because people are sort of expecting, right? It's like speculation, right? They're sort of expecting this thing that they call the fee switch, where they switch on a fee that then accrues to the treasury or the token holders in some form, right? Because currently none of that happens.
Right, but
So
it could be subject
to
a community or governance vote, and then that part of the treasury is being paid out to the governance holders. Yeah. Let's say going 3 months back or something like this, for instance, right?
Yeah, that's something that could happen. But currently, if they did that, I mean, the treasury currently only holds Uni, right? Because all the treasury has is what they have generated at TGE. That's it.
Oh yeah, right? Of course, because yes. But I imagine, I mean, they must be generating revenue. I mean, there are fees being,
no, they don't go to them. The fees, they go to the liquidity providers.
Ah, that's true. So there is no cut going into the treasury.
Currently not. No. I mean,
interesting. I mean,
yeah.
So how do they out of curiosity? I mean, how do they pay their team? I mean, I'm sure they must have a team
on
tokens. Some kind of. Yeah, sure.
They
Okay.
pay, and as long as Uni tokens have value, that works. But if they don't, then that can go sideways too.
I'm not sure if you guys are familiar or aware of this project or protocol called Resonate.
No, I haven't heard of it.
Essentially, what it does, I mean, it does many complicated things with NFTs, so financial NFTs. But the main way projects are using it is it's basically what you do. You trade. So you lock let's imagine there is a liquidity pool that pays rewards in project tokens. Let's say for simplicity, it's 10% APR in a year and that goes to those that engage with this LP, and they have the token in their hands and they can sell it, do whatever they want. So Resonate, what they offer you is that you can set up a pool, or I think they call it a pool, where you can take this LP token, you can lock it for a certain duration of time. Again, let's say a year to keep math simple. What you do then, as a holder of that LP token, you give up this 10% APR, but the project that is, let's say, launching that pool with Resonate is going to give you today, at the day of the lockup, let's say 5% APR, but paid out in something else than the team token. So that way, the project can control their own emissions, right? Because I give you today 5% in stablecoin, but you give up 10% APR over a year in my project token. So that goes back into the treasury, but then of course the treasury has to pay the stablecoin, right? So it needs to have some stablecoins accumulated. And there are many more applications of how you can use Resonate and do different constructs where you kind of trade. You can actually do it the other way around. I mean, your treasury has a token like Uni. So you would let users go and take an LP that for instance you're able to set with Uni, To the Resonate, you lock that LP token, but here you'd give up your, let's say, stablecoin revenue in exchange for Uni token paid out today. So all the revenue would flow over this, lockup period, let's say a year again. It would flow into Uni's treasury, but the Uni gives or pays at the day of the lock the Uni token in exchange. So it's actually quite interesting. So you're basically trading, like future APR for a lower APR, but today, essentially.
Yeah, and in a different currency, right? Mm-hmm. So it allows you to diversify in a way. I think that's what a lot of these protocols have problems with. Is they hold a lot of their own tokens, and you got to be really careful with that, right? Because if you put them on the market, that will impact the price. But you also might need once in a while some other form of payment.
Yeah, definitely. So I think these guys from Resonate, they are launching, I believe, this or next week on multiple chains. I'm also discussing with them a possible partnership for my project. So, but they have, I believe, secured 30 or 40 different partnerships with different protocols that they would be using their vehicles, you could say, to build some kind of construct that would allow to trade, time for APR time for a different asset. And one of the projects that are going to be actually using this Resonate is Olympus, actually. But Olympus, what they will do, because they will be buying, or they will be taking back their own token, right? So you are giving up the token emissions in exchange for some money paid out to you today in stablecoin, right? So this way, can kind of decrease the inflation, or even maybe do it deflationary. I don't know, but that's the intention, I think.
Yeah, they're actually pretty cool in like changing and evolving their own tokenomics. I think like it's changed a lot since last year.
Oh yeah,
this time,
absolutely.
Right?
And I think in a smaller brother, on smaller scale, I think it's Hector on Phantom. If you are familiar with the project, it's one of those Olympus forks that survived, but I think they managed to evolve and change their token quite a bit as well. And that was probably that's why they are still in the market. I think they are probably one of the only ones left on Phantom chain of those original Olympus forks.
Yeah, there's probably a lot of those.
There were a lot of those.
Most of them. Yeah.
So sorry again, change the topic again to something else, but I thought that this Resonate, it offers quite an interesting take on what you can do with your own token. Going both ways, either buying it back or also releasing it to the community or to the users. And I think it's actually a tool we are also considering. We're now kind of looking at the tokenomics and how to kind of work on the emission schedule and whatnot. We also take into consideration Resonate and how we could incorporate that into the entire kind of landscape of our token design. So definitely, if you guys are into tokenomics engineering and design, I think it's a cool tool to also have at your disposal to kind of propose to projects, to use and to kind of offer, more flexibility in terms of like
for like yield futures.
Exactly, and how to. It's essentially a tool to control the emissions, right? The supply-demand curve of your token.
Yeah. No, I get it. It's an interesting one. Maybe you should do a piece on that too.
So sorry.
I'd like to shift the discussion a little bit. So I really appreciate your deep insights, Firefly, and your and the ideas, not the ideas, but the different projects that you brought in. I think the coolest thing about tokens versus shares is that tokens give us this endless innovation, whereas shares essentially derive value from regulatory frameworks, right? Because unless there's laws and judges enforcing that this share is actually worth a piece of the company, it wouldn't work, right? And so I think tokens are fundamentally different in that. Although granted, we probably do need some regulation. But I would like to see if we can shift back a little bit more again to the shares versus token one guy I invited, and I don't know if he actually has anything he wants to contribute, but I wanted to at least give him a chance, is Malik. And he's the founder of Tokenfolio. So he's working in the space of tokenizing shares, I think, if that's right. And I just wanted to see, so because you had reached out to me after the Unfold conference, I just wanted to see what you make of this of this discussion, basically.
Yeah, man, for sure. There's so much info here. There's so many interesting points that were mentioned. So the main thing we are solving, at least on our end, is like we think about tokenized shares pretty much all day long, because we are building a platform for tokenized shares. So essentially, we are trying to bring shares on chain and bring all the functionality that we have with tokens, and at least open doors to sort of like that innovation here, because this entire share space is like quite old, and we didn't really see a major innovation in this. Of course, government regulations and legalities are a challenge, so things are slow moving. But I think we cannot really compare tokens and shares directly, because tokens are a lot more advanced. And let me give you an example. So when you have shares, let's say 1% of the company share represent 1% of the rights or ownership of the company, which is the angle we can compare. Like if you hold 1% of all the bitcoins, that is kind of an analogy you can do. But then Bitcoin, of course, is now also being used as a transactional vehicle. And if you think about ETH, then you have a lot more use cases, right? As like for paying gas, for a number of things. So I think so. What I'm trying to say is that shares are basically a vehicle where, like, with which you can scale as the company will scale. On the other hand, tokens are that, but all tokens are also bringing out real world use cases. So, which is why I believe we can really compare directly PE ratios that the way we do in stocks. This is one, and but again, like it, of course, it can give you some indication here. Secondly, the inflation rate and all, right? All these things can be quite different as well in terms of shares. For example, let's say a company raise seed round, and then they are going to raise, let's say, I don't know, Series A. Now, whether they based on the negotiations with the parties, then the new investors, if they ended up diluting 20% or 25%, that can change the inflation of the new shares issued quite highly. So it's not a predefined metric really. And of course, markets are down, valuation can change. So the inflation we have in tokens are, can be predefined in most cases. So this is another pain point that share has, because it's very illiquid, it's very archaic of a system, right? So because of its old and illiquid nature, I would say tokens are a lot more advanced, where you can program things, where you can plan things better, we can predict things, and even actually bring use cases. So those are the so based on this kind of discussion we had now about PE ratios. So those are the some parallels that we see, at least, and what we're going to do on our end is at Tokenfolio, the platform we're building, is basically tokenizing shares. Now that once we have that, it will be easy to you will have that angle maintained, which is like, hey, it's like a governance token really. As Flo mentioned, I think one of the best ways to compare these is like closest to shares are governance tokens, because that's basically the same thing. Like, they don't have much use case apart from, of course, like you can vote and all, but it represents the ownership, and you will grow with the company as the company will gain value. But yeah, so the main idea is that apart from that, what we're trying to do is like just bring these things on chain, and so slowly we can bring all these use cases and functionality, and sort of take shares from archaic old instrument of gaining wealth to like much more where we can have like real use cases and stuff.
So to that last point, you reckon that if, for example, stocks were to trade, I guess, like on crypto rails, do you think maybe the perception would change as to like how the supply inflates?
Not really. Like, if you can bring a system which is like a Web2 based system, and the trading is smooth and no problem at all, like to the end user, it doesn't matter if it's based on a blockchain or like, I don't know, normal MySQL table or whatever. what problem that we have at let's see, let me give an example of secondary shares. Now let's say you are an employee or an angel investor in a company which is not public yet. So this is actually the another important point. We are trying to do this for companies that are not listed yet. So be it startups. So we basically are making vehicles for people to invest in tech companies, be it an early stage startup, be it an pre-IPO firm. Because once it's listed, trading and all, like a lot more vehicles are there. The space is digitalized after that. But in the area before, let's say secondary sales. If you have to sell your secondary shares, there are share transfer forms you have to fill, and there's usually 1 to 2 months of waiting because company has the right of refusal, so they can like try to stop that. And then even after that, right? So for every single trade you make really in that space, the turnaround time could be quite complicated, like quite long. And of course, there are huge fees in that process as well. So now imagine all these things are on chain, and I can just send you my tokenized shares in your wallet. Like takes 2 seconds. So will make the entire space a lot more liquid, which is not the case at the moment.
And you don't think that will have an effect on, I guess, like how shares are released into the market, and obviously, yeah, the supply dynamic to that.
Shares released in what? Are you talking about the fundraising bit when company issues a new share?
No. So well, yeah, sort of, I guess. So whenever currently when, let's say, a project releases tokens, as Flo mentioned earlier on, like everybody's very wary, right, of unlocks or anything that's released into the market because it affects, I guess, price, right? And again, I don't know if that's because of maybe like there's more regulation in the traditional like in stocks, in the stock space, and maybe a lack of regulation and maybe ease of liquidity in the token space, right? And I just don't know if like that is something that will eventually be ported to stocks too, right?
Yeah, for sure. So this is actually very, very interesting point that you mentioned. So think about this in this way. Like, let's say all these blockchains that were launched, Solana, Polygon, or whatever, all these companies face issues that their tokens were, or their instrument was trading at a very early stage, let's say seed level, which is not the case in companies. So you're right, companies, let's say, are not used to having their token or trading issued at an early stage. So that will change their processes a little bit. But pretty much entire crypto space went through that, and I would say they adapted, and like it's a solved problem. So we have like more than enough use cases, or sorry, examples how companies managed it. And of course, companies do a number of things, like they do AMAs, they do like community updates and stuff. It's not legally required, of course, for companies or protocols to send updates to their communities, but like that community angle is pretty strong in the open space for that reason. So similar things, I would say, if a company is launching, and by the way, when a company is having a tokenized share, that doesn't mean they have to trade it. There are like the companies we are speaking to, there are a number of use cases. For example, they can issue ESOPs. Now, instead of doing paperwork for every single employee, it's like we can issue tokens or ESOPs to your community or your employees, like with code, which is a lot more scalable, a lot more faster. Same goes once the tokens are issued, the employees will have much easier path to like be able to sell it once they are vested and stuff, right? So that's one use case. And plus also you can have like lending, borrowing in the space, where you can use this tokenized shares as a collateral, depending if the company is big enough or not. So like, if the credit risk is there or not. In that case, if let's say company is $1 billion company, private company, that's a Stripe, it's almost like 90 billion. That those tokenized shares could easily be used as a collateral on chain, just like Aave does with ETH. It's a big enough project, bigger than most crypto projects out there. So without now selling your shares, you have an option to have liquidity while still you hold your share. So I mean, beyond trading, there are a number of things you could do, and there are many reasons why you want it. And lastly, with secondaries, it's a lot more easy now. You don't have to the way at least our legal structure is working. Any number of parties who are holding these tokenized shares, they on the company cap table, on the paperwork, there's only one party, which is our trust. So internally, like now we basically have a vehicle where, if you know what these special purpose vehicles and stuff, something similar to that, where now people can just swap tokens at any rate they want without having to like sign paperwork. So we basically, our goal is to, like, in that way, just to remove this archaic process while keeping the regulations the same. Of course, we're not trying to change the laws, but like, you know, it's like trying. So these tokens are like what USDC is to US dollar. These are like that to shares. So basically digitalizing the space. I think I went all over the place. But
Okay, yeah.
answer your question.
No, it makes sense.
Yeah, we would love to hear if you guys have any thoughts with. So like technically we are trying to bring tokens and shares closer. But yeah, wondering if you have.
So I guess like Mirror used to do something similar. I'm not sure if they're still going, and obviously they were on Terra, weren't they? But they also did something similar with like their M shares. Yeah.
Yeah, it's not the same thing really, because what they used to do was like in simple words, they used to just reflect the or their token was not backed by an asset. They were just basically showing whatever. Let's say Apple stock has a price feed from Nasdaq and stuff. So it was basically a tokenized version, or a token was representing that. So the main difference here is that a lot of companies, a lot of Web 2 companies are trying to launch their own token, and I think it becomes a little scammy if the company has a cap table and then a company try to launch a token table, because incentives are not aligned anymore. Like investors and founders own the wealth which is in the cap table, and now you launch a token table where you try to sell or raise money from your community, let's say, because the real wealth is in the cap table, right? So this is an example of this happened in India, Indian company. This is a short video app called Chingari. They launched their Gari token. And there is like $40 million in 24 hours last year, and their token was like later crashed to, it's like 95% down. So out of those $40 million, most people lost almost all the funds. On the other hand, founders didn't lose money, investors didn't lose money. Like the company didn't lose money, but the community did. So it's very like hey, bull market is here, let's just raise money and just like forget about the community. I don't think it's gonna anyway play very well with the firm, right? That community trust is hard to gain after. So what we are trying to do also is like having a better way, giving a better way for non-crypto companies now to enter in this space. Because even today, like crypto is still a small niche. Most companies are non-crypto. Most startups that are coming are non-crypto, but that doesn't mean they have to follow these old and archaic instruments. And they're just launching on token just to raise funds, and is, as I mentioned, can be quite scammy. Which made sense back in the day, like in 2018, because regulations were not there. These tokens were in very much gray area. So as a company, if you wanted to have your token, there's not much you could do back in 2018. But now things are different. Now we have security token regulations. There are exchanges that are specializing in security token trading, and they have licensing done for those. And there are more than enough jurisdictions where you could do it, like UAE, BVI, Cayman, Bahamas. It's not in gray area anymore. Actually, most people don't. It's like very much like things have moved, at least in the last 1 year. So now when things are not in the gray, if a company still launches their utility token, which is not aligned with, like their own company, it's as similar as, hey, I have my main company and I'm raising money through it, but then just to scam some people, I'm going to just launch a subsidiary and then distribute them the fake shares of the company. Like it's almost similar to that.
That's it's really interesting. I mean, the whole thing is, I guess, I don't know, a couple thoughts that pop into my head, but they're not in any particular order. We had this whole discussion once about if something backed, like a backed asset, can ever be decentralized. So I guess when we're talking about tokenized shares and tokenized equity, I guess, I mean, in that case, I mean, you want to own the asset, right? So there's like no really any point in in kind of insisting on this decentralization thing, which I guess in many cases, well, of course. I'm trying not to cross my references, right? But so having something like a Bitcoin, which is a decentralized asset, of course, has value because of its decentralization. But then when we're talking about equity, we want the centralization because otherwise there's no actual enforcement mechanism that what I own is in fact that equity, right?
Yeah. So sorry, is there more you wanted to say on this?
I don't know. So this is just a thought that popped into my head. I just wanted to see what echoes back.
Yeah. Actually, I don't believe it. I mean, we will be decentralized in any way here because the legally binding asset or legally binding thing is actually still that paper, which basically mentions that, or the cap table of the company, which is still, the legal instrument will be still that piece of paper which mentions that, hey, you own X number of shares. But now what we're trying to do is like exactly what USDC did with US dollar, like these apps, Venmo and stuff, right? There are parties that sort of represent this online US dollar, in their app, and then they can send people can send it to their friends without have to carry change and all that. But internally, they hold that actual asset, and they make sure Venmo makes sure that the dollar that they show on the app is actually backed by an asset. So it's something similar to that. So I think path to the decentralization will at least not be achieved in the medium to long term. And I think it doesn't really make sense here. So it's also because like we don't need that here. The company, if a Web2 company is trying to launch a token, it's a company legal entity is very centralized of a thing, but still, let's say Stripe, still there are a number of use cases that will be unlocked for Stripe's employees, their founders, their community, and everybody who basically wanna sort of come in as an investor in the firm, be it a retail investors, be it a crowd. So I think there's not much to be achieved for fighting for decentralization here. What we are trying to fight is for trying to sort of digitize this space and eventually slowly, let's say, bringing lending, borrowing like DeFi protocols here. So bringing more use cases in this older space. I would say removing paperwork, removing all this, inefficient and slow processes.
Yeah, and creating liquidity, right? So this was one interesting case that I thought that you had mentioned was VCs often own share ownership in all kinds of projects, all kinds of startups, but it's very illiquid. And so tokenizing that might actually unlock liquidity. Could you say a little bit about that? I thought that was very interesting.
Yeah, actually. So there I would say there are two sides of the coin that we have found in the conversations. One, there are more people now who want to invest in tech companies than ever before. Like people want to be angel investors and stuff. And this number is only going up thanks to these shows like Shark Tank India and stuff. But the average investor doesn't have a way to come and invest, and paperwork is too much. People don't understand safe contracts and all that, like legal terminology. On the other hand, investors of big companies have early employees, founders, and investors. They all have same problem that, hey, I own a lot of wealth. Some people I spoke to personally recently, I have this conversation every week. Hey, I own $2 million worth of shares in this company. It's a big company, great company for sure. But I cannot use it in any way. It's like you own an asset, but it's like logged until IPO happens, and there's no timeline for it. So that there's a lot of pain around that. And personally, I'm like, hey, why? If it's a real asset, if it's like your own wealth, why can't you? Like, there should be ways for you to use it. And then people that are trying to come in and people that are trying to liquidate. So there's an obvious bridge that we see at least that can be sort of, this problem could be solved by tokenizing it. Now it's like can be as simple as just now being able to send tokenized share to your friend through their phone number. It should be as simple as that because it's your asset and it's your friend. You should be free to do the trade if you want to, right? So it's like it's also about like bringing more empowerment, like empowering more empowering people to use their wealth in a more efficient way.
Yeah, I think that's a really cool use case that I guess tokens are unlocking. Yeah, thank you so much, Abhishek. I kind of wanted to bring it back now and see, Flo. I'm sorry that I kind of took the discussion away from you a
No
little
problem.
bit. But I thought this was super interesting. I learned a lot. We're like at the top of the hour. I don't know if we want to keep going or if we're close to shutting it down, but either which way. I think it's safe to say that the token versus share discussion is probably one of the most maybe most requested, but like there's a lot of people very interested in it, understanding the subtle differences and kind of the opportunities on either side. So I think this is awesome.
Yeah, I don't think it will be the last article on the topic. So yeah, cool guys. I think we already have some ideas for a second version of this. We'll see when we can get that done. But thanks for joining and making this interactive. Thanks,
Awesome.
everyone.
Thanks.
Thank you, guys.
Have a great day.